This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 54. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, everybody's favorite boomer. And we got Rich Diaz of Acorn Macro Consulting. What's going on, gentlemen? What's new?
What's new? What's new is old again. Boris Johnson's going to make a comeback. No, I'm kidding. Liz Truss is probably the major news thing that I think we should probably laugh at, talk about, sigh. It's pretty embarrassing, but in the UK, nothing's beautiful day. And Liz Truss, after 45 days, has resigned as prime minister after her plan basically went down in flames. I just like to thank all of the bond vigilantes and the people shorting the pound. Thank you very much. That woman was wholly unqualified to lead the Great Britain, and on to the next one, I guess.
There it is. Spoiler alert. We'll get into that later in the show. Keith, what's going on over there?
Well, I've had a busy 48 hours. I just had a trip to New York. That was lots of fun. I'll share that story as we go on. But it's a typical Wall Street, 24-hour visit. You talk about money, and then there's hookers and blow involved. That's the way New York rolls.
And jumping into walls with Velcro suits.
How does Mrs. IceCap feel about this?
She wasn't there.
People are probably like, this guy's serious? Jesus. I want to party with him at the Hockey Hall of Fame.
Right.
Yeah, speaking of which, I've got, if anyone can see, I got my Rich Diaz t-shirt on today. I'll be rocking this at the live event in Toronto, December the 1st. Plug December the 1st, guys. So you guys are listening to this podcast right now. We're recording it on Thursday. This is dropping on Friday. This is dropping on Friday. Tickets are now officially on sale. So it's December 1st in Toronto. That's a Thursday. Doors open at 6 o'clock. So basically the itinerary quickly is 6 to 7. Come in. You get a complimentary drink ticket. Come in, and then after that's cash bar, have a couple drinks, mingle, walk. We rented out the entire Hockey Hall of Fame concourse. So like all the jerseys, memorabilia, video games, everything. You're going to have access to that entire thing. That's usually a $25 entry fee. So that's waived. That's included in the ticket price, which is $59. Includes a complimentary drink, appetizers, and then we're going to be doing the live podcast plus Q&A in the TSN theater room. So it holds about 150 people in there, and it's going to be a great setup. And then afterwards, we're going to open it up again to like more drinks, cash bar, appetizers are included, and there's going to be like virtual games. You can kind of wander through the concourse. It's going to be a blast. We've had a lot of emails, DMs about tickets asking for a while, so I think this is going to move pretty quick. But yeah, come hang out. It's going to be a great time. Like I said, there'll be a link in the show notes here to access the Eventbrite page to go purchase your ticket. So that's it. Keith will be there with his shitty jokes.
Go Habs, go. I'm going to count all of the Habs Stanley Cups over and over and over again. That's what I'm going to do.
Do you guys remember the TV show? Geez, I'll come back to this story when I remember. Apparently, here we come. Father Ted.
Boomer moment.
Yeah, it's a boomer moment. Father Ted. It's a BBC
I've
show.
heard of it.
So, so one thing that's great, you got the whole, British, prime minister story going on. And, they're comparing her life cycle as prime minister to the life cycle of a head of lettuce. Weren't they doing that this week?
Yeah.
Wasn't that there?
Yeah, it's amazing.
In Canada, it's like, we think we're witty, but we're not very witty relative to the Brits. Like, you guys are just outstanding over there. But years ago, they created, the Irish created a sitcom about these Catholic priests living on this little small island called Craggy Island. And the Irish TV studios, whatever they were called, they turn it down and said, no, you'll make too much fun of the Irish. We can't do that. Of course, the Brits, they say, well, we'll do it. So the BBC picked it up. And it's a great show. It's called Father Ted. It's about like this very senior priest. And then the main priest, his name is Father Ted. He's the main guy. And then the young guy is Dougal. And so he's kind of like you, Rich, in that he has a lot of enthusiasm about stuff. But so your love for the Montreal Canadiens, he has the same love for the Irish soccer team. So he sleeps with his jersey on every night. So I envision you're kind of doing that kind of thing these days with the Montreal Canadiens.
The best
How did
part.
you know I sleep with Montreal Canadiens boxer briefs?
Oh no!
All right, here we go. So guys,
No wonder, is this thing filmed in black and white too, or what? Jesus.
Yeah. Father Ted. It's one of the all-time greatest shows.
Father Ted.
Cool.
There you go.
Yeah.
There's a couple of happy boomers in the YouTube comments. Let's dive into it this week. We got a lot to talk about. We got some updates on the Canadian housing national figures, more movement on interest rates. We've got a Bank of Canada policy meeting next week, so there'll be a live Twinkie bet here coming up very shortly. And then obviously, what's happening with the Fed, Japan, the UK. There's just a lot of moving pieces these days. Every week seems to be exciting. But just looking on the national housing front, we had the data that came out. So you have national house prices. They slid another 1.4% month over month in September. So 1.4% in September. So national house prices, since peaking, they officially peaked in March as per the home price index. They're now down 14%. So that is the steepest correction since the index was created in 2005. Like I said, the last deepest correction we had was 9% decline, peak to trough. And so right now we're sitting at 14. And given the recent move here in rates, I think there's probably more pain to come, because we've seen, not only are we going to see a Bank of Canada rate hike next week on October 26th, but we're seeing an increase again on fixed rates. The Canada 5-year bond continues to surge higher. So we've seen your typical fixed rate mortgage is up about 30 basis points over the last 10 plus days. So that's a big move. Your Canada 5-year government bond right now is at 3.78, which I believe is the highest going back to 2007. I don't know if anyone's got that on the top of their screen there, but 2008. So there you have it.
2008,
2009. Yeah. So
crazy.
More pain to come. We're going to get into the Canada's inflation data as well. But let's leave that there for just one moment, because I want to touch on the recent movement, the recent backup in yields. Keith, do you have any kind of thoughts on this? I mean, you're seeing government bond yields continue to push higher. You have a situation where governments are still out there doing deficit spending, and obviously inflation concerns are still elevated.
Yeah, like that. It's starting to, I don't want to use the word taper a little bit, but I guess that's what we have out there. This relentless rise in long-term yields, it's still happening. And it seems like every time central banks, no matter which country you're in, they talk hawkish, and will come in what the Bank of Canada will do next week. And then the Fed is on the week after that as well. But it's happening from an investment perspective. It's still pretty tough for people who are stuck in the bond market. And that's continuing to happen. I think the next thing, though, that's probably going to be, well, it is becoming more of a conversation again now. Remember a few weeks back, we started talking about there's going to be a recession coming up. And no, that ain't going to happen. It's not even close. And now that's mainstream thinking. Who I think
months,
one of the
not weeks, months. You were on it really early, Keith.
Yeah, and I'm just being, Keith, but
humble brag.
Humble, yeah. But which one of the Canadian banks came out? I think yesterday or before, they're predicting basically the first half of 23. So the first 2 quarters of 23, Canada will be in recession. And like we said last week, we're going to start seeing some monthly data prints coming out now to see whether that's happening or not. So if that's happening and you're stuck in the bond market, you're not in government bonds, you're more in credit, so corporate bonds. And most people's bond portfolio is a bit of both. So you would have taken it, up the nose with rates going higher. If we go into recession and it's a hard landing, like it's not one of these mild recessions, then your corporate bonds, they probably won't have a good time either coming up. So it's all tied together, Steve.
Yeah, there's a good little chart here on Twitter here. It says from Bank of America Global Research, year-to-date annualized return for the 60/40 portfolio is the worst in 100 years. So
Ouch.
enjoy your retirement.
Ouch.
You'll be working for a lot longer.
But that's okay if you're older and you can't tolerate risk. You should be in the bond market because that's what the Canadian investment industry tells you all the time.
Ouch.
Plug ice cap. So
but this sort of I think this will tie into some of the meetings I had down in New York there yesterday. So again, like everything, it is tied together. So I think it'll be a fun story that we'll.
You want to get into that now, or you want me to keep spewing out Canadian?
Well, we can wake people up with my story, or you can.
Yeah, your stories are good. You fire away. Keith was hanging out with all the guys.
Well, I was going to say we could stick to Canada and talk about inflation, or we can do that.
Now let's wake him up a little bit first. We'll
all right.
Snooze later.
You set him up, and I'll put him to sleep.
I'll line him up. You can knock him down. How's that?
That's right.
Okay, so jokes aside, though, I was in New York for it was literally 24 hours, but I do work with a guy down in the U.S. And with the work that we do together, we know some bigger names, and we just get opportunity to meet these guys. So yeah, but in New York, so we had lunch with one of the guys who was featured in the Big Short movie and book. So I'm not going to say which
it was Steve Carell.
Ben Bernanke.
It was the actual person. It wasn't, Ben Bernanke.
It was the mortgage broker.
Yes, that's the best guy.
Yeah, those 2 guys from Florida. Yeah, it wasn't that.
Or was it the stripper?
It's a stripper. We win.
The stripper with 5
houses and a condo, right? But so we had lunch with this guy, and we're hanging out for probably an hour, maybe hour and a half, whatever. And it was kind of interesting, right? If you meet people who gain celebrity status for whatever reason, my approach is to never bring it up. I just don't, talk about it. And that's just what I do all the time. But this guy, he's still managing money, of course. He's really deep into it. So you want to share ideas and say, hey, what are they thinking? And just because they got it right once before, it doesn't mean they'll get it right again. You know what I mean? It's just the way it works. But the main way to describe this guy, and he said as well, like he said, like 3 of us, so myself and the other guy I was with, he said like we get along because we're all skeptical about things. And the reason they had success back during the housing crisis, because they were skeptical about stuff, and they were able to see through all the BS out there and see through the industry, and they know how things work and how money flows. So that's how they got the opportunity. So, we're going back and forth, having a great conversation, but, just to sort of summarize it, the views that they have today, it's very similar to the views that, three of us are talking about all the time. A lot of other people that I know as well. But that view, it's probably represents, I'll say 1% of the market. Because most of the market, 97% is always asleep. They just sit on the money and that's it. And the 3% that's awake. Of that 3, 2 of them think the US dollar is going to crash because of, the twin deficits and stuff like that. Then there's the other 1%. And they see things sort of in line the same way that we see. But so the biggest risk that we talked about with this guy was we say, okay, well, exactly, where's the risk? Like, where do you see things really breaking these days? And he said, he said, the biggest risk today is in sovereign debt markets, which is totally aligned with what we talk about as well. Yeah. And this is the next part, which is a great member. Like, we didn't share notes beforehand or anything. He said, however, governments will do everything in their power to contain the risk in the bond market. So this is Japan today, because if they let the bond market go belly up, it immediately puts pension funds go under, insurance companies go under, banks go under, governments go under. Like, nothing works in that environment. So we all agree that they will always do whatever they can to try to be like the Japanese are being proactive about it. The Brits were reactive about it, right? So, and then of course, the conclusion was that the risk will get expressed in currency markets. And again, like, that's what we talk about quite a bit these days. So, that was his view. And, there wasn't a lot of other, you can ask me questions. I'll say, yeah, actually we did bring this up and that up, but that's the general view, and they're positioned for it as well. And a lot of people in their network, they're positioned for that too. So there's this.
What are they positioned for? Are they positioned for the government to come and protect the bond yield, or are they positioned for further pain in the bond market?
They're positioned to benefit in the FX market.
Okay.
So because the bond market, because they're suppressing price discovery in the bond market, they know the risk will get reflected in currency markets, right?
Okay.
So if you think about that now today, like over the last few weeks, we've had the Bank of England, they've had to interfere into the bond market, the rescue, the British gilt market. The Japanese are also doing it on their end. They're trying to save both the bond market and the FX market. And we'll talk about the Japanese in a second. And then now over in Europe, they're doing the exact same thing. And in all three places, this is the irony involved. So, most people that are listening to our show, I chat with a lot of people out there, and everyone's really in tune. Like, it's great. We have a great echo chamber, by the way, and I love it. But
is that a good thing?
Yeah, we all love it. Hey, you have a rich voice today. That's good.
Well, better.
Hey,
Thank
Keith,
you.
what's the what's your opinion of, like, what is? I mean, we've talked about this before, right? You've got this sovereign debt bubble. Like, literally, the title of our last podcast was, Canadian government facing, surging interest costs. So all these governments around the world, we've got this inflation problem. Rates are going up. The bond market's doing what it needs to do. And it doesn't seem to be a whole lot of discussion around, at least in the mainstream, around, governments and their ability from a longer term perspective to service the interest costs at these levels of interest. Where do you feel today is the greatest risk at the sovereign level, country-wise?
Which country you mean?
Yeah.
Yeah, so this will come into the next meetings they had as well. So just tying it together. So if you think, and this will apply to Canada. So right now you have the Japanese, the Brits, and the Europeans. They're all raising interest rates, as the Americans are, and the Canadians and everyone else. But they're also doing QE.
Yeah.
So they're doing this to support. So it just doesn't make sense. I mean, like, there's no.
Well, it's yield curve control. They're managing. They want to manage that price of the bond, which is another way of saying they're managing the yield curve, isn't it?
Yeah, but that's providing stimulus. So they're providing stimulus at the long end of the curve, right? Because they're trying to keep rates as low as possible. They're also indirectly funding the government on the fiscal side.
I'm aware of that.
Yeah, Rich gets in trouble when he talks about that. But they're raising rates on the short end of the curve. So like none of this makes sense. And again, like this is something that we're always talking and laughing at because again, like you can't teach this in university because it doesn't reconcile. It just doesn't make sense. So when you look around the world, Steve, and say, hey, like what's going to happen next? The likely event in Canada, for example, is that you can see the Bank of Canada, they're still raising rates, but they have to start QE again. Right? That's the next step that will likely happen as we continue to go around the world. And, so again, like I got a lot of stuff. I don't mean to dominate the conversation today, but a lot of it is sort of tied and linked together.
Well, no, I mean, I think like just coming back to Canada here, right? I mean, like you said, like the Canada 5-year bond yet continues to float higher and higher. And it's like, at what point do things just completely, like, you know what I mean? Like you have mortgage rates at 6, did they get to 7? Can they get to 8? Like it just, with the amount of debt in the system, and you've built an entire economy on basically asset prices, particularly in housing at a certain level, people just think you can't just have, let's say, a 50% collapse in national house prices without wiping out the banks, right? So it's really not as simple as just giving it a quick cleanse and saying, okay, this is healthy for the market. Let's reset house values to, whatever price to income ratios you feel satisfied with. It's really, I think for people listening to this, it's not that simple, right? So there's a lot of moving pieces, but yeah, Keith, to your point, I think, does the Bank of Canada really have though the capacity? I mean, we're such a small, really in the grand scheme of things, a meaningless country, the ability to actually run QE. Like every other nation would have to run it first, I would imagine, before the Bank of Canada could come in.
Well, I mean, they're already running it, of course, right? So really, the Canadians and the Americans, they're the ones that are not doing it right now. But think about, because it's the other thing, like for example, because I shared the challenge that the provincial bond market has up here. There's no liquidity, right? And he's laughing. He said, "Yeah, we're well aware of it. We're watching that closely." And then we joked about, okay, how do you play that market? And it's like some of these opportunities are hard to do sometimes. But Steve, let's just say we get a situation where rates do scream higher and the interest burden scream, like we keep using Newfoundland as an example because they have the highest percentage of their tax revenues going to that right now. So just say all of a sudden, they need help. So the Bank of Canada, they'll announce QE again, but they'll do it as a general blanket statement. They're not going to say it's just for Newfoundland, because then Newfoundland's getting bailed out and you just can't run in, and the Bank of Canada can't bail out Newfoundland. Ottawa has to bail out Newfoundland. Do you see what I mean? So I could easily see the environment coming up very soon when the cost of rolling over debt for whatever reason, it just spikes higher. And then the Bank of Canada has to step in. So to keep an eye on that. Then any of these events is likely going to be coinciding with, a risk off in other markets. So, I mean, like we are not very positive on the Canadian dollar at all. We hope our view it doesn't play out, but the opportunity is there, for Canadian dollar to come down hard.
What do you see as
the US dollar versus the US dollar, to be clear?
Correct.
Sorry.
What do you see as the opportunities, or the probabilities, I should say, of like one flush higher in bond yields, like just like a one?
So that's
big,
where I want to
move.
step in. That's where I want to step in, because I think that we're sort of talking cross purposes here. If we're absolutely convinced that there's a recession, you can make the case that the US has already been in recession, 2 negative quarters of GDP growth. And you think that in that recession, you're going to have demand destruction, and you're already starting to see inflation expectations roll over. We talked about that last week, those 4, 5, 6 different indicators. The idea that you wouldn't want to own bonds at 5% at the front end of the curve, or maybe at the long end of the curve. I mean, the reason bonds got killed is convexity and duration. When you have a really, really low interest rate and you go up to like from 50 basis points to 1, you get absolutely killed. When you're at 5%, let's say I'm looking at the iBox overall global bond yield at 5.1%, you're being compensated for term premium, inflation. If there's really terrible growth, it's not necessarily at all clear that you wouldn't want to own those bonds at these levels. And again, under the premise that you're convinced there's a recession. So even if you, because of the duration and because of the income that you're now getting, even if you go up 100 basis points, you only lose 1 year of income. Whereas 6 or 10 months ago or 12 months ago, you would have lost 4 or 5 years of income. And so that's where I think I'd like to push back on this view that you would never want to own bonds. I can't believe I'm freaking saying that out loud, but I think things have changed a bit.
So that this sort of ties in. So, after we had lunch with this guy, we then had a meeting with, it was about a dozen pension funds and other institutions from some of the Nordic European countries. So they were over. So they wanted to hear. By the way, guys, my friend is Brent Johnson. So Brent and I are over there together doing these meetings. And
Name drop. Boom, the milkshake man.
Yeah, the milkshake man. By the way, Brent's one of the nicest guys around. He really is a good guy. Anyway, so we're chatting with these European pension fund managers and things like that, and that was one of the questions. He would say, they said, one of the guys said, it's a lot easier today holding, say, a 4% T-bill, because you're going to get 4%, which is a lot better than zero, about a year ago. Plus, in their view, same with ours, maybe they can pick up another 3, 4, 5, 10% on the FX side. So Richard, your comment is absolutely right on the front end of the curve. Of course, it comes down to how much further will short rates go. But if you're just holding the T bills on that side, or a 1 year note, that is the opportunity now, is absolutely there. But the risk, though, with everyone else is that an event happens that causes the bond market to spike, so yields to spike higher, like the UK event as an example. And so that sort of ties in. So one of the conversations that we're having with this European group, so if anyone knows pension fund management very well, they use a thing called LDI, liability driven investment. That's one of the names they'll attach to. So basically, people only think of pension funds as assets, a big bucket of money. But pension funds view themselves having a big bucket of money and another big bucket. That's the money they owe out to pensioners. And there's a lot of things involved with it, but you always try to match your assets to your liabilities. So you can be in the pension fund world. I had this conversation about 5 years ago up in Toronto with a couple of funds, and they didn't believe me at the time. And because if long-term rates scream higher and they lose money on their pension assets, right? Because rates went up, the price of the bonds went down. They said that doesn't matter, because then when they're discounting back their liabilities, it's discounted back using a higher rate, which means they owe less money. So they say it's a wash. They're not concerned about it whatsoever. To which, I replied, I said, well, what if you have permanent losses on that bond portfolio? And they said, oh, we hold sovereign debt and double AAA rated corporate debt, mortgage-backed security, CDO, CM, you know what I mean? Stuff like that. So in that whole world, the entire concept that the bond market was risky, it didn't exist, but now it does exist. So this group that we were speaking with, they're very concerned about being able to structure correctly, to protect themselves. And the point is, everyone's just trying to protect themselves these days because they're afraid of, the big sort of black swan event in the room is the dollar surging higher, screaming higher. And the best thing is everyone is now aware of it, but few people still believe it. A lot of people still believe it's going to go the other way around. So, it's a great opportunity to make money if that event happens.
There you go. What about, wouldn't mind touching, Rich, do you want to touch on Canadian inflation? I know we touched on briefly in the early of the show, but I mean, again, a lot of this obviously hinges on, we're talking about recessions and inflation and where yields are going. Everybody seems hyper focused these days on every CPI print, right? Everyone's just salivating on their screens. It's funny. It feels like it's been so interesting because I always you just pull the average person that you walk in, down the street, or you run into a coffee shop, or, I got other realtors in our office here. And the fact that everybody's like now, like, hey, did you guys see the latest inflation data coming out? Like the fact that everyone like that doesn't even pay attention to finance is now talking about like the CPI release is kind of hilarious. But I don't know if you want to walk us through your stats there and any sort of thoughts on the most recent drop.
Sure. I mean, but before we get into that, I would say that to me, that is a massive contrarian indicator.
I agree.
I use, not to be total prick, but I use CBC, for example, as my contrarian indicator. I've actually mentioned this to my mother and my sister, you know, when they're listening to the radio and they hear about a particular financial or macroeconomic phenomenon, I ask them to report back and to tell me, because to me, that's the signal that that thing is now over and it's been priced in and it's well understood. And lo and behold, the inflation that came out yesterday was the September number, even though it's October, obviously. And headline inflation fell again. Again, the rate of change is falling to 6.9. Core rose slower than I don't know if it was expected or not, but it's clearly starting to roll over. The key thing for me was goods. Goods continues to fall on energy, transportation. Those are the big things. Unfortunately, food, which we still eat, thank God we don't eat bugs yet, that continues to rise. You know, you got other things like shelter, which we've talked a lot about. I was expecting it to roll over with the weakness in housing. That didn't, so it still contributed a significant amount to inflation. You know, I think we always talk about this, the 40% number, right? Yeah, core was 5.3, shelter was 6.8, but its contribution actually grew a little bit. So we've talked about this. It's going to be sticky. One way of measuring that stickiness is looking at services inflation, which stopped rising, but it's still quite high at 5.57. And then my favorite numbers, which the Bank of Canada completely ignored, because why hire a bunch of PhDs if you're not going to ignore them? Seems like the right thing to do when you're a central bank. The Central Bank of Canada has 3 preferred measures of core inflation, and all 3 sort of stopped rising and have started to fall. So I think that, you know, back to my sort of being a bit of a prick, but the point about CBC and your regular guy being a contrarian indicator, I would say that is, you know, it's holding true in this circumstance. Who knows? I think it'll be interesting to see how food gets higher and higher. I'm surprised by that number, actually, because we import a lot of food. The energy piece, you know, is definitely starting to drag on inflation. I think so. Let's be careful about that. Who knows what will happen in Russia and oil? Again, Canada does not refine any oil, or very little. We produce about 5 million barrels a day, and we refine about 1.5. If you're wondering about gas prices, you know, and you see Joe Biden, for example, release the Strategic Petroleum Reserve, that's specifically to do with the lack of refining capacity, not the crude oil capacity, which is related to gas prices and which is related to energy component CPI, on and on and on. But anyways, so that's starting to drag on inflation, and we'll see. I mean, you know, that's why, you know, again, back to this bond conversation, you know, how you value bonds is trickier than how you look at value or valuation for equities. For equities, you look at price earnings ratios, dividend yields, price to book, price to sales, EV to EBITDA, on and on and on. For bonds, you look at things like inflation, you look at growth, path of growth. You might add those together over long term. You might look at things like duration, convexity. What are you being compensated if things go wrong? And, you know, in a world where inflation expectations do roll and you do get lower inflation going forward, I can't believe I'm saying this, but those bonds at 4, 5, 6%, we're talking about government bonds, are starting to, I don't know, maybe they're attractive again.
The YouTube comments are going to go off, but
I know.
I mean, it's
so
Rich, but
Rich,
it's
Rich, what if you met a bond right now at a bar? What is your pickup line?
the Montreal Canadiens boxers.
I was going to say inflation expectations are starting to roll over.
Yeah, like I somewhat agree with what you were just sharing with us. The market view on the latest CPI number was that it was quite hawkish.
Yeah.
So so when you're managing money, you know, our view, it's irrelevant sometimes. It's how the data is received. So just so everybody knows that the data that did come out, it was received to be quite hawkish. I share your view as
And
well.
when Keith,
Rich, by the
when
way.
Keith says hawkish, he means like the market was like, oh, the inflation basically isn't coming down as quick
Fast
or as
enough,
much as
yeah.
they had hoped. So obviously central banks are going to have to basically do more on the inflation fighting part, just so there's some clarity there. Continue.
Yeah, that's absolutely right. And plus the Bank of Canada, they were out speaking this week as well, and they reiterated, what was his exact words? Yeah, inflation remains the most immediate threat.
Yeah.
To mankind, personkind, whatever they want to call it.
Yeah, person kind.
This is,
Right.
to me, this is great news because Keith, you mentioned we should think about what is and not what should be, and what is that they're going to tighten too much.
Yeah.
Right. I think that's, in my view, that's my view. I think they're going to tighten too much, and too long, just like they tightened too late and not enough at the beginning of the cycle. Because if you look at just across the board, all the components I think are starting to weaken. And so it's weird to me that
this probably brings us to our Twinkie bet for next week then.
Oh yeah, there you go.
Well, we get into that in a sec. I got some
needs
more
to
commentary
say
on
something.
that. I'm upset. No, just the reason why. It's just because we talked about it earlier about the sentiment side. All the comments on YouTube, and I get DMs on Twitter or Instagram. Everyone goes, how can you say inflation's coming down? The amount of lopsided commentary that I get, everybody's on the same trade, that inflation, and to your point, Rich, it is changing from a rate of change perspective. It's almost impossible to beat last year's 8% year over year growth. I think the argument that people keep coming back to is yeah, but just wait, there's not enough oil going around, and Europe's going to be going through if you look at utility prices, gasoline prices in Europe, they're down a lot. I mean, again, they're probably going to have another spike back up, but to me, it's so overhyped at this point.
I agree.
I think, yeah. Well, one of the comments you made, I think for people to maybe appreciate, to say inflation is coming down, it doesn't mean prices are coming down.
Right.
It means that prices are not going up as fast as they are. I know, people who are not in the investment world, let's say, man, that's just screwed up, man. That's bad. But this is the investment world we live in. That's the way that they'll price things. So at some point, and we're not there yet, by the way, because we'll do our bet here in a second. But the central banks, they're going to continue to raise rates. Right now, they're telling you, we do not care what the inflation rate number is coming out. If it supports us, that's great. If it doesn't, we're going to come back and tell you next week your thinking is wrong. So, but the great equalizer to this, for them to really get inflation down, is for the economy to come down hard with it. And as we keep saying, now we're entering that time frame when we should start to see weaker data come out, which will bring demand down, less money that people have to buy things. And it's a very soft way of saying not a nice event, right? A recession is not nice, but it's likely where we're headed.
Pretty rare to see a central bank cheering on a recession, though, right? So it just kind of highlights the interesting times that we live in. I
got a story.
I got one more thing on the inflation thing, as I put it on Twitter. So the one thing you'll notice, Rich, and I'm not sure if you took a close eye at it or not, but I was screening through that CPI report, and so there's two things that were saying that were contributing to I don't know if they call it the rise in inflation, but because inflation was maybe more sticky than we had initially expected, was that they have furniture and car prices still are accelerating to the upside right now. And I don't know about you, but everywhere you go, every furniture shop in Vancouver is reducing their prices. They have too much stock. The days of record home sales and everybody trading homes and going and buying brand new furniture to furnish their new home is no longer a thing. There's 20-year lows in transaction. Nobody needs a new couch. You've had two of the largest furniture stores in Canada reducing their headcount, reducing their employees. And so we're saying, furniture store prices are going up. Extremely skeptical there.
And then the other thing was they have car prices are still going up. Yet if you look at the Manheim index, which tracks used car prices in the US, not only are they not up, but they're down 10% on a year over year basis. So used car prices are down 10%, but StatsCan is saying car prices are still accelerating to the upside. And I've had several anecdotal stories in the last couple of weeks of people that ordered new cars to purchase, and they were given timelines of, oh yeah, you'll have your car in six or 7 months, and all of a sudden they got them in 4 or 5 weeks. And this is people that are very, very close to me, and they're like, oh yeah, my car's coming in, like I gotta go now sell my used one that I have here because I wasn't expecting it until March and it's coming in next week. And you're like, well, that's weird. Like, so I just look at some of the data. Sometimes you have to, like, we're obviously trying to be data driven and factual type of podcast, but I think sometimes you have to overlay the anecdotes and start to sort of do that juggling act of, like, is the data telling us the whole picture here?
So I just add something really quickly? So I totally agree. Sorry, Keith, just really quick. But I totally agree with you, Stephen. I would just remind everybody that when inflation was starting to rise and we were incredulous about the numbers and that it took a while, the truth is it's a lagging indicator. It's year-on-year stuff. But the other thing that I think is important to note is that there's information in the price. So something I look at is something called bellwethers. We've discussed this before. So like stocks have information. They have the expectations of future cash flows that are priced in the market. That is information. And when we look at like housing, I can't remember the names of Sleep Country, all these like whatever housing markets, you look at, all of these different stock prices will have sort of quote unquote anecdotal evidence on particular economic and macroeconomic phenomena. Sorry, I just wanted to add that.
That's a really good point.
Keith,
I love anecdotal because the data we look at, it is lagging. It takes a while to come out and stuff like that. Anecdotal stories is real time. So that I love that, Steve. That's a good.
We have to stress test. You have to stress test those views with raw data, with sentiment, with market pricing, with anecdotes. That's how you.
I actually want to get your quick opinion on this because this is a very interesting topic, and like I said, I love sometimes just chatting with like the normal person out there that isn't finance focused, doesn't really care about macroeconomics, but they might read the odd news headline, and everybody is convinced that the Bank of Canada, no matter what, or the Fed or whoever central bank you talk to or follow, is that until inflation gets to exactly 2%, interest rates will keep going up. And so everybody's so focused on inflation coming from 8 to 6.9. They're saying, well, it still has to go from 6.9 back down to 2. And I would argue, I'm curious your thoughts, maybe we don't ever get inflation back down to 2 for the next several years. Maybe we're just at 3, 3.5. Maybe do central banks find a way to live in a world with 4% inflation for the next 2, 3, 4 years?
No.
You don't think so? Okay.
I think yes.
Well, maybe Rich doesn't understand the question.
Will inflation be 3 or 4% for the next 4 years?
No, I think I interpreted the question as, do central banks believe they can get it down to a certain level and it'll...
Oh, that part. I ignored
that
part.
No, my question is, my question basically is, my personal view on the world today is that inflation is coming down. It's going to continue to come down because we're engineering this hardish landing. But I think that you could still be in a world because, we've talked about the energy shortages and whatnot, and labor force and whatnot. I think you could very well be stuck in an environment over the next 2 to, let's say, 5 years where inflation is stickier at 3 to 4%. And so do central banks, they have an official mandate, quote unquote, of 2% inflation target. Does that mandate have to somewhat evolve and change for the times, which is like, you can raise rates as much as you want. There's no guarantee that you're going to get inflation to 2%. Can they and will they potentially live with inflation at 3.5% for the next couple of years?
Yeah, I mean, they'll move the goalposts, but here's another thought. For the world to go into an environment where we're getting 2 or 3% inflation year after year for the next 1, 3, 8 years, whatever you want to talk about, by default, you're implying that there's no crisis in the bond market, right? Sovereign debt becomes resolved and all that. And I don't think that's possible. I think there is going to be a resolution to that. A resolution to a bad debt problem is bad debt gets recognized. So I could see us going into a world where there is a sovereign debt crisis that does happen. And if that happens, you know what happens with your 3 or 4% inflation number? Anyone? Bueller?
Goes down.
Yeah, it's a negative sign in front. So you get this massive deflationary boom.
Yeah, I'll definitely take
Right?
the other side on that. I'll take the other side on that.
But by taking the other side, Rich, it means you believe there's no problem in the bond market around the world.
I
That
think
everyone,
there absolutely there's a problem
Yeah.
in the bond market, and the way that you solve it is having your implicit price deflator, your nominal GDP, your inflation for the whole economy be very high, or higher, than target for a long time. If you look at debt to GDP ratios across the board, they're already.
but it doesn't work though.
coming
So
off.
walk me through the
What do you mean it doesn't
environment
work?
where
It's worked in 1946 to 1960 in the US. It worked in Japan. Japan's debt to GDP has actually come off its highs. Nominal GDP
So
is a
for
very powerful
today-
drug.
So for today, then you're implying we have to get the economy to grow again at what, 4, 5,
No, in nominal
6?
terms.
Yeah, absolutely. So
So
then
you can
okay,
your
8,
real
9,
GDP
10,
is
8 or 9
your
or
real
10. Right, walk through the numbers. How are we going to do that by having governments not continue to do deficit spending, by have central banks not having higher rates, by not having, all these things? I know it makes sense in theory, but my view is that that's what they've been trying to do, and it still hasn't been. But think about it, we've had 0 and negative rates for about 15 years almost. And the only thing that it's fixed is that it's enabled everyone to borrow more money. So I don't think, I'm not a believer in that we can get through this current. I do think that we've reached the top of the debt mountain. Something has to get restructured. And I don't know if it's sovereign debt gets restructured, household debt, corporate debt, but it doesn't continue along this path without because there's bad debt out there in the world, without it getting marked to market.
I agree. However, I agree with that. It's fine. But I think that no one is going to want to face that pain. And the way that you deal with the fact that nobody is willing to take any kind of austerity, there's no political will to deal with austerity. There's no political will to take any kind of haircuts on any of this bogus debt. And the way that you get around that is the tried, tested, true, you inflate that debt away. It's as old as the Romans. I really,
but
this idea that people are just
right
going
now,
to get together
they're trying to take away the inflation now. So it's the opposite. I don't understand. Again, I can't reconcile how it works.
I get that. But all you need to do is you have your nominal debt to GDP. Sorry, your nominal, the implicit price deflator go at like 6, and it totally changes your debt dynamics quickly. So it's just, it's not, you don't need a lot of inflation. You need just more than what we've had. And then, for all the things that you've mentioned which is all these like negative impulses that are dragging down inflation, I would submit to you that the labor market forces that we've talked about, the age dependency ratio, is positive for wages. I think that the idea that, you have a situation where the labor market is going to win versus corporates. You have an age battle of old boomers who are asset rich versus young, less.
Did you say boomer?
Did you say boomer? For me, the idea that all these countries are going to get together in a room and then give everybody a 60% haircut and everybody's going to walk away happy without war, to me seems very unlikely. And the more likely scenario is how all of debt problems have always been solved, which is you inflate it away.
There was a good piece from Russell Napier. I mean, I don't know whatever your thoughts are on him. I think he's a well-respected guy, but he's rightfully called disinflation for the last decade plus, and he had the inflation call this at the beginnings of the pandemic correct, and he just updated his sort of piece, and yeah, I think he shares a similar view to Rich, which is he feels that inflation's actually going to settle in around 4 to 6% over the next 5 years or so, and he thinks that governments are basically going to continue to fund massive deficit spending through government guarantees on credit issuance. And he believes that central bankers have become impotent because governments have actually become they've taken over the printing press, so to speak, right? If the government can provide government guarantees on commercial bank loans, it prompts commercial banks to issue more credit and expand the monetary base. So it's interesting.
Yeah.
Again, he's not to say he's going to be completely right or wrong, but he views that inflation will be elevated, and it's just something that we're going to have to eventually just learn to live with and tolerate. And that will, to Rich's point, that will deflate your debt to GDP burdens over time.
To get, I know that piece that Russell just put out. To get to that point, it's implying it implies that central banks or governments are nationalizing the global bond market. I mean, that's effectively what it's talking about. And if you do that, risk will get reflected in the currency market. So,
but if everybody's doing it,
it doesn't happen all at the same time, Steve.
Mm.
Like, for example, let's just say the Brits weren't able. The Brits got bailed out with the Fed, by the way. The Fed, everyone, they're pumping billions these days, like through the various swap lines they have to help everyone. And they only help their friends. They don't help their non-friends. So China, for example, like they're in serious trouble. But if you're just say in Canada, let's just say our currency goes to 50 cents and everyone else in the world, it doesn't, their currency stays flat. All of a sudden, we're exporting deflation out of Canada. So whoever buys Canadian stuff, which is oil, but we're importing inflation, right? That's what happens in that environment. And is it going to be Canada, the Japanese, the Australians? I don't know. But again, like this belief that we're going to be able to go from a period of 40 years with rates always coming down and then hitting zero and staying flat for 15 years while everyone borrows beyond belief. And that includes everyone listening, right? Households as well as corporations and governments. And then all of a sudden rates are taking off again and expecting things to settle down without someone not bearing a cost. So as an example.
We do know who's going to bear the cost. Sorry, go ahead.
We all do it. But that's like it's socialized. So as an example, pension funds, I would argue most of the big pension funds in the world today have about anywhere from say 5 to 30% in private equity or private debt or private credit, whatever you want to call it. And a lot of this stuff is when you mark that on your book, because there's no open market for it, you basically price it at what you believe the correct price is. I'm seeing it now, and it was obviously what we heard from some of these meetings over yesterday. There's now a growing belief that the marks on a lot of these private equity, private credit, or debt issuances out there, it's priced up here, whereas we know that the equivalent liquid markets are priced down here. So the reason that's a challenge, and remember these pension funds, a lot of they do it through third-party managers and stuff like that. If all of a sudden, you get that first olive moving out of the jar, you can't get them out; they're stuck together. You eat olives? No, okay.
I love olives.
You love olives, but you get they start coming rumbling out one at a time. But there is an opportunity here when all of a sudden you get a liquidity event in private equity or private credit. And all of a sudden, everyone has to mark these positions to market, which is what the actual price is. And then all of a sudden, you have a lot of these pension funds, all of a sudden they're boom, 10% gone, there she was, permanent loss on it and so forth. So again, this thought that the world is able to smooth over any potential loss in the bond market. That's completely false. That it ain't going to happen. So because it ain't going to happen, I don't know how we're able to extend to a nice soft landing. Yes, Rich.
Wait a second. The bond market in the UK is down like 40%. There's the 20-year Canadian bond is down 30%. Is that would you consider that a soft landing? I think that you've already seen a significant, as you've described it, permanent loss in these bonds. Because I don't think I would not, I don't think the UK gilt is going to rally from here to recover all of its loss. So in a way,
well, it's not permanent. So a bond it doesn't have a permanent mark on it until it's,
I know. I get that. But what I mean is like the index level, the bond index is down, 30 and 40% in some cases. And so isn't that the pain that you're describing? I mean, if you look at LQD, which is an investment grade bond ETF, we're down 20%. If you look at HYG, which is a high yield bond ETF, you're down 20 and 30%. So you've already had a significant re-rating in those bonds, much the way that you've actually described. So, if it goes down another 20%, you're down at 50% for peak to trough. Man, that's a hell of a re-rating. And I'm not saying that's going to feel good. Don't get me wrong.
You have to look at it. You're looking at it from like a private client retail investment perspective, from a pension fund perspective. If all of a sudden you're gated on your fund, you can't get your money out, and your defined benefit pension plan, and you got to do these actuarial studies. I think it's every 3 years they're required to do it. And all of a sudden you have permanent losses. And then the company who the plan sponsor is, it might be the government, it might be a big company, who knows, they have to start, putting more money into it. I'm just saying it creates the potential for a liquidity event where all of a sudden, so you want to get back to that magical growth rate where, where Dora the Explorer is sprinkling pixie dust everywhere and all that stuff. You can't have it, because then private capital, it's not going out into the economy. Like it's frozen. So and again, these are the risks. Today, of course, I've started going down this path where the sun isn't shining, but it sort of ties in with, if you recognize the potential risks that are out there, and doesn't mean it has to happen, but boy,
we agree on both. We agree on that.
Yeah, it's going to be really hard.
I agree.
To come. So the best case scenario for the world is that we do get a bit of a soft recession, and the recession lasts for 2 or 3 years. It just becomes a grind, and we will adapt to that. Like the Japanese yen, for example, they are adjusting to a gradual, continual decline in the yen. If the yen goes whap, right? It gets whacked really hard. That's not good. I know you saw the Japanese export numbers. Did you see those last night?
No.
Yeah. See, money never sleeps. By the way, that's one of the reasons why I'll never be able to stay in New York full time or anything, because I like my sleep.
It's crazy
to get
there.
it.
Can I ask you a question, Keith? Which is, you mentioned, you mentioned, what do you think governments will do? Do you think they'll just keep on, printing money? And do you think they'll just keep spending and keep deficit spending? We're about to walk into the November midterms, something we haven't discussed at all. And we probably should, given we made a prediction at the beginning of the year. And the Republicans are going to take control of the Congress, maybe the Senate. Who knows what's going to happen in 2024? But my question to you is, do you think that the populist Republican president, who will no doubt be elected in 2024, do you think he'll run a budget surplus or a budget deficit?
It's impossible for the Americans to run a surplus. Structurally they can't do it, because the amount of mandatory spending, I think that's the word, is it mandatory or whatever?
It's Social Security that's locked in.
Yeah, just Social Security, and then their defense budget. Even that's enough to overwhelm. So my answer is no. I don't think any government, if we have a new Canadian government coming in, just to say it came in tomorrow, are they going to start running a balanced budget? No
way.
they'll come out with a plan that after 5 years it'll be balanced. And guess what? Never happens with any of these. It doesn't matter which that they're not able to do it.
But then that's my point on the whole inflation thing. You need like this idea that there's going to be austerity as like the linchpin of this deflationary view. I don't buy that. And maybe that's a conversation for a different day. We can explore that. Maybe
Curious just to kind of wrap
couple weeks.
Yeah, I mean,
I just don't think austerity is happening.
This is a prolonged conversation for the Hockey
Yeah,
Hall
sorry.
of Fame.
Yeah, that's right.
December 1st, but I'm kind of curious, Keith. Did you guys chat about? I'm just looking at the screen here. You know, we chatted when we started opening the show here. We had the Canada 5-year bond at 3.7, ending up the show here. It's now at 3.85. You know, moved 15 basis points in an hour. Wow. So this is not a healthy functioning market. I mean, Keith, do you follow at all, like a whole lot, like the MOVE index, which was created by I think it was Harley Bassman there, Mike Green's buddy. The MOVE index, which is currently at 147, it's higher than the onsets of the pandemic there at 133. So you really have extreme volatility in bond markets right now. I mean, how much are you paying close attention to that?
Yeah, well, you know, I have the MOVE index on my screen here. It's at 147.73 right now. I can see it. So one of the view right now with that is because, you know, the Japanese are trying to, you know, defend the yen. The Chinese are trying to defend the yuan. And by the way, the Chinese are fixing CNY a little bit higher, like every single day. Like they're really struggling. But this ties back with the Japanese export numbers. Rich, you should take a look at it. Their exports are surging.
Oh,
like
yeah. Okay. Sorry.
Yeah, like really great numbers. And if you do it just on pure production, like units that are sent out, that's not increasing. Well, sorry, it is increasing, but it's all being driven by, you know, devaluing their currency. So like when I talked about people can adjust to a gradual movement in any market, you know, the Japanese are. So they're saying, yeah, we're going to defend the currency. We'll defend the currency. They're loving this now. This is great. If it can trickle lower all the time, it's great. But see, but to answer your question, so there's the conversation that's out there now is that, you know, the two biggest holders of treasuries, you know, would be the Japanese and the Chinese. They're selling these to get dollars, you know, to try to defend their currency. So that's having a lot of a impact on the market. And when people hear that, they're thinking, oh man, the dollar's in trouble if the Chinese start to dump treasuries or if the Japanese start to dump, you know, treasuries. But what they don't realize is that the amount of savings that continues to come into the system on a daily basis from pension fund savings of all types and corporate money that has to be rolled over in the treasury departments, just world trade in USD, that all buys treasuries. Like it's always overwhelming. So you're not going to get this huge flush out in the treasury market. So I actually agree with Rich with the long treasury bond. So in both Canada as well as US, I think the opportunity is coming up here where that's going to be a real good entry point. Because if we do get a recession, which I suspect we are going to get, and it's not this, you know, crisis moment, then it's I think people can make a lot of money on the long end of the treasury market curve. We got to do our Twinkie bet, guys.
Twinkie bet. Yeah, wrap up the show here. Who wants to go first, Keith?
I'll go first. Do you guys know the data yet, or are you just, you know,
October 26th? So Wednesday next week. We'll be obviously recording on Thursday, and so we'll have an update for you guys next week.
Okay, I'm in for 75.
That's market expectations, by the way. 75.
Yeah,
boring.
Exactly. That's it.
Rich,
what do you got, Rich?
I'll go 50.
Oh man,
it's like he's not even trying. He's like he's guessing all the time.
50. I was gonna go 50.
All right. Well, the two of us can have. We can both go 50.
Well, I'm gonna go 50. I was gonna go 100 just to spice it up, but I just don't see it happening. I'll go 50 with Rich. So the two millennials here are gonna go 50 against the boomer.
So we'll see how this one plays out. Twinkie is on the line. As always, guys, we appreciate your support. Again, there's going to be a link in the description to go get tickets to the Hockey Hall of Fame, Loonie Hour Live, December the 1st in Toronto. We appreciate your guys' support. As always, we just ask that you share this episode with at least one friend or family member, and we'll see you next week.